So we all think we know 3M because of Post-its, but it's much, much more than that. Why don't you just give us a little introduction to the company?
Yeah, fundamental to 3M is our value model. The value model is strong, and it starts with what we call our fundamental strengths, and that's how we leverage synergies across the enterprise, our technologies and our technology platforms shared across all of our businesses, our manufacturing capabilities vertically integrated around the world, global reach to our customers. These are the synergies that make us at the enterprise greater than the sum of our parts. And then we prioritize ways to create value, and that's innovation and managing our portfolio that drive us forward.
A lot of companies emphasize synergy. I used to work with the Walt Disney Company, emphasizes synergy, has done a good job with that. But you also apply science to it that is not true of all companies.
Yeah, and if you look at those technology platforms, science is what drives those. That is science applied to solving our customers' problems. And we think about our customers as companies, homes, every life around the world.
All right, so 3M has been in the news recently reporting first quarter earnings that missed estimates to such a degree that the shares took their biggest tumble in about 30 years. I'm wondering what went wrong?
Yeah, and we've been talking about it starting with our earnings call last week. Q1 was a disappointing start to the year. We were impacted by several key end markets that we have been talking about even as we exited 2018. We saw soft demand in those end markets. That decline accelerated as we went through the quarter. Even as we came out of February, March, we just saw accelerated decline in those end markets. And we took actions to adjust for that. We weren't able to compensate for the decline we saw, and we just delivered soft growth, I would say, relative to our expectations, and disappointing earnings in the quarter.
You were disappointed. Were you surprised? Did it raise any questions in your mind as CEO? Do I have the mechanisms in place to really monitor what's going on in real time?
Well, we didn't take enough action in the first quarter, and we've talked about that, and we are taking aggressive actions now. We are executing. We know how to do this. We know we'll lead into challenges like this. We'll lead out of them as well. And so our team's on it, and we are taking actions as we came out of the quarter and really aggressive actions as we go into the second quarter.
What are some of the aggressive actions? So some people are saying the fact that you bought back, say, more than $700 million of shares in the first quarter as the shares rose, perhaps that could have been deployed elsewhere.
Yeah, and we have a long strategy to share repurchases, and we continuously are in the market around that. But our actions are really around getting our operations aligned to the demand that we see, giving us a chance to continue to execute that value model, but adjusting to the demand softness that we saw. And so the actions are taking down costs, of course, aggressively taking down costs and how we operate, especially the businesses that are challenged, and then looking at our manufacturing. We're vertically integrated in manufacturing. We've got to adjust those production plans. We've got to be more aggressive in doing that. We've got to make sure we're managing our cash as we go through slowdowns in key markets. And then we announced some restructuring really to better align us to where we are in the markets in 2019.
As you looked at it, where was the biggest misalignment if you weren't aligned? Is it China? Is it automotive? Is it electronics? Where specifically did you see the biggest issue?
Yeah, the soft end markets, those are the three key end markets. It's China, automotive, electronics. That's about 30% of our revenue focused in those areas. And we saw a decline accelerate, as I said, as we went through February into March. And as you see soft end markets like that, the distribution channels that you work with, they also react and they take inventory. So it gets multiplied as you go through the quarter. That tends to get back in line. The channels adjust quickly. But as we go into the second quarter, it now becomes a story about what is end market demand going to do in those areas. And we're positioning ourselves with our actions to be ready to lead back out.
Are you changing your supply chains at all?
We have global supply chains. We have a strategy to be close to our customers around the world. This has served us very well. We've been in markets like China for more than 35 years. And this is part of our strategy to be close to customers. We adjust as needed, but we have a lot of flexibility in our supply chain to make the kinds of changes that I'm talking about and be in line with the end market demand.
As you go through the entire operation and you take costs out, you become more efficient, how do you make sure that you don't undermine your ability to deliver as things come back?
That is the big challenge in adjusting to these kinds of situations. It's not simple across the board kind of cost cutting. You have to be focused. You've got to be aggressive because you've got to get in line. We've got to deliver. It's one of our hallmarks is we are able to make these adjustments and be in a position to lead back out. So you got to stay true to that value model, stay focused on what you know will take you forward. And that's the key for us is making that right balance across the board.
So you talk about weakness in China, and that was one of the issues here. And we were just speaking with Candace Bagson-DeFeer at Capital Partners, and she was saying that she thinks people are too pessimistic about China. From your vantage point, where do you see the Chinese economy, and do you think that people have adequately priced in the weakness there?
You know, the three end markets I'm talking about, these are some of the most attractive markets we face for the long run. China, of course, a very attractive market for us to grow in. And even as we talk about challenges near term, we have a strong healthcare business in China, growing double digits in Q1. It really is focused on these key end markets in automotive and electronics. These are big market segments for us in China. We see that as the driver near term. China long term, very attractive place for us. Near term, we've got to really make sure we're aligned to what the current demand is.
And what about the U.S. economy? I mean, you have a lot of feelers out into the U.S. economy. What are you seeing?
Yeah, the broad macro in the U.S. still looks solid. And across our business, we have very good areas of growth for us. Our broader healthcare business is doing well in the U.S. Our consumer business is strong, actually growing above GDP as we come through Q1. We have some pockets of softness in the U.S. as well. Automotive, kind of that theme, a little softer in the U.S. We see, some areas in pockets business that are off to a slow start, but we expect those to improve as we go through the year.
So you talk about electronics and autos as particular weak spots. How long do you expect that weakness to persist?
Well, there's a lot of people that see it improving as we get to the second half. I would say we're taking a more cautious view of that. We're watching it. We're very close to the OEM customers, the original equipment manufacturers, the makes and models that you know out there. We're close to them. We see their demand, and we'll respond to that. We're hopeful that it'll improve as we go through the year.
You emphasize innovation an awful lot at 3M. How do you innovate for an economy that's evolving directions that we may not even be able to anticipate?
Yeah, it starts with being very close to our customers and working with them and what they're doing, what they're trying to solve, and finding those even unarticulated needs they have for new innovation. That's where it starts for us.
I want to come back to one last question about what you're doing right now, and that's about your balance sheet. There are some people who are questioning your leverage, essentially, as you do borrow money. You continue to borrow money, and as you said, you've got a long-term plan on share buybacks. Are you concerned at all about your credit rating and whether you get up to a ratio that actually will undermine your credit rating?
We've laid out a 5-year plan around our capital allocation and our balance sheet, and it starts, the first priority is organic growth, investing in R&D and capital investments to drive organic growth. We have a long history of paying dividends, 100 years paying dividends, 61 years of increasing dividends. That continues to be a hallmark and a priority for us. And then the flexible capital we are going to deploy. We like the opportunity with acquisitions to complement what we do organically and leverage those synergies. And we'll continue to use share repurchases as part of that allocation.